Hello, everyone. Welcome to this week's installment of the Grain Gauntlet. As always, 5 questions from current clients and at least one from a prospect. Lots to talk about this week after we closed out August with a little bit of a rally. This is Patrick. I'm Josh. Ready to go?
I'm ready.
All right, here we go. First question asks, how far can this corn rally go?
That's a good question. There's a gap on December corn at 432. We could get there, although it's not really a price thing. It's a timing thing. I believe the rally has been due to 1.3 billion bushels of corn that was left over at the end of the year, made supplies very tight. Demand has been excellent because we're below the price of Brazil as far as corn goes, and for beans for that matter. So demand has been strong. Strong demand, small supply leads to a rally to get that crop out of the farmers' hands as much as they can. I think end users are starting to be bought ahead enough to get the new crop now, because we're seeing basis widen. 20-year lows I've been hearing in the Dakotas for basis. That means end users aren't going to buy until after the forward pricing contracts that have already been made by farmers are filled, and they need to buy more mid-harvest. That's why I do believe it's a timing issue, not a pricing issue. I think we're really close to that time. We start heading back, and I do believe we'll see at least a double bottom in corn market by mid-harvest.
Okay. All right. To build on that question, are you adjusting your corn positions with this move higher?
We did early because we had some very, very cheap calls that we could buy against our hedge without taking off our hedge. I always have a position on that protects in case of drought, so we don't get big margin calls. I hate margin calls, especially big ones. So we had a sold $5 put for most people on, which allowed us to benefit on move higher. Bottom line is we had the hedge in place, and now I've been starting to take off with some profit on the bought cost. I'm making a little adjustments in the account, but the base hedge position has remained in place.
Okay. You want to stick with that for a while going forward?
I am looking at this thing going down to 380, maybe upturn bought puts in short futures. For example, a 430 bought December put right now has about 10 cents of time value. If I exit that and go to short futures, I pick up downside protection 10 cents quicker. So those kind of changes we can make depending on marginability of the farmer, risk tolerance of the farmer.
Okay. All right. How much will weather matter to prices now that we've hit September?
Not a whole lot. I mean, 15% of the corn crop is now black layer. So there's no more growth there, and yield is fixed on that 15%. Very little fill is going to be added or test weight over the next 2 or 3 weeks. We're really close to harvest beans. Still maybe some weather effect. A good rain right now would help the bean crop to be finished.
Okay. All right. Next question. Do you think we still retest lows on harvest pressure setting?
Yes. Yeah, I know how you talked about that already. Yeah, definitely. I think we're going to have, we added over 2 million acres of corn in the last USDA report. Think about that. That is a lot of product we have to move to market where we can put all these bushels, okay? Even if yield is 8-9 bushels lower than what the USDA said it was, we still have massive amount of harvested corn and soybeans without enough bin space across the United States to put it anywhere. So we're going to have this situation where at the peak of harvest, there's no place to put these products. Why would an end user buy ahead when they know that's going to happen? Why would they push prices up when they know that's going to happen? Harvest has to happen. And when it does happen, there's going to be a glut. That is factual. There's no guesswork here. So why would we not think it would go back down? Now, let's say I'm wrong and we go to $5 because demand is so great, he races everything, and there's no glut of harvest, and it's just amazing how strong. Great. Great. I have $5 sold puts protecting the top side. I'm not going to lose anything in the account. We're going to sell corn at a much higher price. You guys will be tickled pink. You'll all be calling me to buy calls because that's what farmers love to do is buy calls and be long. It'll be a beautiful thing. If I'm right, however, where's your risk? Outlook is great, but measuring your risk reward is how you should market. And right now, the risk is great to the downside.
Yeah, I definitely see both the questions I'm getting from farmers, and I see the talk in the marketplace, other marketers out there. It seems like everybody's really anxious to get to that buying calls moment and not thinking about still protecting downside. So
Let me ask you a question. Yeah. If we're at 380 December corn or 420 December corn at harvest lows, what is a higher probability of getting the $5, 420 price or the 380 price?
I mean, from that point,
Yes, 420. Right, of course. So Fred 420, great. We're gonna get a rally. We're gonna probably get to $5 a lot more probable than if we're at 380. Okay. And the reason because 420 indicates more bullish fundamentals, 380 more bearish fundamentals, much less of a probability of rallying up to $5. That's why you should be covered right now.
exactly. Okay, good. And then final question this week. This one's from a prospect. What do you suggest as a low-cost option to improve on some ugly corn and soybean sales that they've made?
A low cost option. You gotta wait for harvest lows and trying to buy a long position or get in a long position before the rally, after the rally has gone up 20 or 30 cents is always dangerous. So you want to wait for it to go back down and buy then. A preemptive strike, you could buy a 390 December put or a $4 March put with the expectation that we're going to go down to those levels. And then you can buy a buyback futures with a very cheap put. Yeah, protecting the downside.
Or bottom line is the way we see it right now. If you're looking to do something right now, it's actually could buy a put.
Buy a put, and if you're right, it goes down to that level. You have very cheap protection. I'd buy a $4, $4.10 March, so you have all the way to spring. And we get near that price level, you buy a futures, and you have a very safe buyback.
Okay, sounds good. All right, well, that's all for this week. Thanks again for all the questions, everybody. If you have a question you'd like to have answered, email it to adminstaff@hedge-plus.com. Otherwise, we'll talk to you again next week.
Have a good week.
Thanks.